Thank you, Fred. Fred is being kind when he talks about the timeliness of this. I originally talked to Fred about this book 3.5 years ago, I think, and the project actually did start at that time. I was distracted in a number of ways in the intervening period, and indeed distraction has been the order of the day, I think, for a lot of my work. But Fred kind of stuck with it, and I'm grateful to him both for agreeing to do a book that is kind of atypical for the Peterson Institute, but also for sticking with it when I kind of moved on to other things for a while and then returned. But as he said to me the other day, sometimes these things work out for the best, and obviously it is timely. I also want to take a moment to thank Ted Truman of the Peterson Institute and Mark Carey of the Federal Reserve Board, both of whom, going well beyond the call of duty, read multiple drafts of the manuscript that became this book. Now, I notice neither of them is here today. So it may have been a bit of this, look, we've done all we can for this guy, and, you know, he's on his own now. But they were both terrific. Neither is at all responsible for anything that is or is not in here. But as I say in the acknowledgments, they made this a better book than it otherwise would have been. So what I'm going to do today is not try to walk through and summarize the book. You've got the book. If you want to read the book, you want to skim the book, you can do so. Or you can just read the introduction, which gives you a 2-paragraph summary of each chapter. What I'm going to try to do this morning, in light of everything that's going on, which Fred has mentioned, is to focus on some parts of the analysis in the book that may be particularly salient under current circumstances as we think about both international cooperation on financial regulation and domestic changes in our regulatory system, whether administrative, legislative, or both. Now, I should say before I get started, and usually you don't have to say this, but I am going to say it, I only speak for myself in presenting this book today. I just want to make that clear at the outset, and will be clear in the questioning as well. Okay, so what I want to do is first talk about the Basel II regulatory paradigm. That is, what is the substantive kind of regulation of financial institutions which Basel II has moved us towards. And then I'm going to talk some about the international arrangement, that is the Basel Committee, within which the Basel II agreement was developed and which will be responsible for implementing that. And just to preview a bit where I'll end up, the intersection of that, of the substantive kind of regulation you're trying to do with the particular international arrangement, the institutional forms of the international arrangement, is very important for determining how successful that arrangement is going to be. And I hope the reasons for that will become apparent in the course of the presentation. So let's begin by looking at Basel II, and let's specifically begin by seeing how at least one bank has responded to the implementation of our Basel II. So as one bank put it, we're pleased to have achieved approval for use of our Basel II rating systems. This means that the benefits of Basel II enable us to increase our interim dividend by 30%, and the payout rate is going to increase. The medium-term outlook for the company is very positive. This coming from the chief executive of the Northern Rock Group, June 30th, 2007, a conclusion with which the Bank of England took some issue a few weeks later. Now, Northern Rock had more to say. The implementation of Basel II results in our Pillar 1 risk-weighted assets as of 30 June falling from around £33.9 billion under Basel I to about £18.9 billion under Basel II, a reduction of some 44%. So the regulatory capital, the required capital buffer, was dropping almost by half. Why? Well, because, and we'll get into this for those of you who don't know capital requirements, why? Because the risk weighting for residential mortgages reduced to the mid-teens, treasury assets, and personal unsecured loans falling below what Basel II would have required. Okay, so it's kind of a backdrop, a way in which at least one bank was looking at things. And by the way, this is not unique to one mortgage-oriented bank in the UK. you can find similar statements, although without quite the dramatic coda, by a number of other banks during the course of the last couple of years. So, how did we get here on capital requirements and Basel II specifically? Well, to understand that, you need to have, I think, a little bit of background in the evolution of banking regulation and banking supervision. These comments are most salient for the U.S., but I think with some adjustments they can broadly apply across the G10 or Basel Committee countries. 35 years ago, bank regulation in the United States was very much a matter of statutory restrictions. There were a lot of restrictions on the kind of activities in which a bank could engage. A lot of restrictions on the kind of institutions, financial institutions, with which a bank could affiliate. Restrictions on how much interest a bank could pay on its deposits. Restrictions on its ability to expand geographically, to do interstate banking across state lines. The result of all of that was a quite confined business model, which had been reasonably, though unspectacularly, profitable for some period following the Second World War, right up until the 1970s. As capital markets evolved and as people looked for alternative savings opportunities, the growth of money market funds, mutual funds, and the like, there came a squeeze on both ends of that traditional bank business model. That is, savers were finding much better places, or at least higher return places, to put their savings, and more borrowers were able to access public capital markets at, again, lower costs of capital for their operational or investment needs. In light of that squeeze, and for other reasons, a gradual process, which at times would accelerate and at times decelerate, began under which banking regulation was largely, well, significantly deregulated. Lots of those restrictions that I just mentioned, which are still included in banking law books, are now vestiges of what they once were, and to a considerable extent don't have much practical bite on day-to-day banking operations. You all know, probably, the succession of major pieces of legislation in the United States and the degree to which the Fed and the OCC administratively deregulated much of banking activity. At the same time, there was an increasing sense that if you were going to deregulate, you needed to have some alternative mode for containing risks to safety and soundness. And the two modes that banking supervisors in the U.S. and to a considerable extent around the world began to gravitate towards were, first, much more supervision of banks' internal risk management activities, and secondly, capital. Now, these two things came from perhaps the same insight. If you're allowing banks to do a lot more things, it's going to be harder to regulate the particular activity or the particular product, the reasoning went. So what we need to do is make sure that there are some overall approaches to assuring the safety and soundness of banks. One way to do that is by requiring a minimum capital buffer, so that if the bank sustains losses for whatever reason, whatever activities it's in, there's a buffer there which will allow the bank to absorb those losses without its solvency being threatened. Similarly, if a bank is to be increasingly engaged in complex activities, derivatives, securitization, and the like, then there needs to be a rigorous internal risk management system which allows people within the bank, right up to the executive officers of the bank, to get a handle on the risks that they're confronting, and thereby to be able to manage those risks in an informed, intelligent fashion. Those were slightly at odds with one another for a while, because the capital ratios, as well as the minimum capital ratios, were very much rule-oriented. The supervision of internal risk management was not. it was basically saying, we want you, the bank, to figure out under our guidance how best to manage your risks. Whereas the initial capital rules from Basel I were quite rigid categories imposed by the regulators. What Basel II does, specifically in the advanced approach, which is really the path-breaking one that I'm going to focus on, what Basel II does is bring those two things together. So the orientation towards the bank's own assessment of risk combines with an emphasis on the capital ratios as the buffer to protect the bank against unexpected losses, to give us the model, the regulatory model, which the Basel Committee developed in Basel II. So these are, I've already really touched on them, but let me briefly, again, for those of you without a lot of background in this area, just so you understand where I'm headed here, talk about the basic modes of capital regulation. You can have a leverage ratio. You just take your total capital and divide it by your total assets. That's a simple test that's been in use in the United States for decades. Canada has it too. Most countries don't, at least to this point. A second way to do it is risk weighting, but risk weighting specifically by regulation, and that's what I mean by Basel I, for example, whereas I'll explain in a moment. The regulators make up a bunch of risk categories and say, okay, look at everything on your balance sheet, weight it depending on the category of exposure it falls into, and then that's going to be the total assets that you put in the denominator of this first fraction of capital to total assets. That survives, by the way, in the so-called standardized approach to Basel II, which applies to most banks, but not the biggest ones. And then you have risk weighting by the bank, which is to say using a bank's own internal credit risk modeling techniques to assess the relative degree of risk associated with each exposure, meaning a loan or a line of credit or a retained securitization obligation, like a credit enhancement, anything like that. And again, the differences, the concept is still risk weighting, but the differences are significant because the question is how much do the regulators impose and how much do the banks figure out for themselves. Now, there are a couple of others here which are not in use, but which are have been proposed by academics, by policy people in central banks, economic researchers in central banks and elsewhere. I'm not going to talk about them today, but I just want you to be aware that there are, at least at a theoretical level, alternative ways of setting capital ratios, and I will actually mention a bit about them later. All right, so Basel I. How did Basel I do it? Well, these are quite arbitrary risk buckets. You say, okay, you got a loan. It's a loan to a homeowner. It's a mortgage. That goes in the 50% risk-weighted bucket. So if the mortgage is $500,000, you drop the amount by half, 50% to $250,000, and then you take your capital requirement based on that. Basel I covered off balance sheet items by converting them to so-called asset equivalents, and then you do the same thing. Given that this is a mortgage or a municipality or a corporate exposure or a bank exposure, those were the categories, how much of a risk do we, the regulators, think on average is associated with that kind of exposure? And then you add them all up and you get your risk-weighted assets, and then after you figure out what your capital is, what counts as capital, equity, subordinated debt, and the like, and then these were the requirements, that the Tier 1 capital, so-called core capital, would be at least 4% of the risk-adjusted assets, and Tier 1 plus Tier 2, some forms of hybrid capital and some subordinated debt, would be more than 8%. Now, let me just tell you, if I came with a sheet that had a balance, the balance sheet of a bank, even if it was a very long one, if you gave me 2 hours, I could have everybody here walking out being able to calculate the capital, almost everybody, being able to calculate the capital requirements of a particular bank. Okay? All right, so how did Basel I do? Because this was in effect from 1988 up until 98 when the renegotiation of Basel began. And indeed, in the United States, Basel I, although supplemented by the regulatory agencies, is still in effect. Well, up until about a year and a half ago, it looked pretty good from a safety and soundness perspective. With the important exception of Japan, we had had a period in which there were relatively few bank failures and in which bank profitability was still very high. In terms of competitive equality, there were always complaints that something favored somebody else, and small banks would worry a bit about it, and banks in one country would worry in another. But it didn't seem to be an enormous problem. Pro-cyclicality, I'm going to talk about that in a second, or a little bit later with Basel II. I would just note in passing that initially people thought that the pro-cyclicality of Basel I would be a problem, and it may have been when it was first implemented, but in the intervening years it does not seem to have exacerbated cyclical moves back and forth in lending money out. Here's the problem: regulatory arbitrage. If you have a bunch of firm categories, you're a corporation, you get 100% risk weighting. You've got a mortgage, it's a 50% risk weighting. Other things being equal, banks will be inclined to lend out the amount that they've got consistent with their capital requirements to higher risk exposures within the same category of risk. So for the example I always use with my students is, if you've got a situation in which a month before Kmart went bankrupt, a loan to Kmart and a loan to Walmart were risk-weighted identically, but you could charge an extra 300, 350 basis points on your loan to Kmart. Again, other things being equal, there was considerable incentive to do so. The regulatory arbitrage, that's a simple example. The stuff was even worse when it came to, you guessed it, securitization. Okay? What would happen in securitization would be that a bank would say, okay, we're going to securitize these 10,000 mortgages, then we're going to slice them up into several tranches. One tranche will take the first loss from any of the 10,000 mortgages. The fifth tranche will be the most protected. Then the bank sells the first 4 tranches and keeps the one that absorbs the first loss no matter where the losses come from among all those 10,000 mortgages. Well, obviously, the risks associated with the tranche that has the first loss are considerably greater than the risks that are associated with holding the actual 10,000 mortgages themselves. But until the regulators caught up with that device, that was a device that was used, and the banks, to some degrees, were able to stay a step or two ahead of the regulators. That was the biggest problem that the supervisors perceived with Basel I, but they also worried that the crudeness of the categories made the risk-weighted asset measure of Basel I meaningless as a supervisory device. That is to say, we don't really know how much risk is there precisely because of all this arbitrage. Okay, so Basel II. Here's the movement to Basel II. And this one is a little bit of dramatic animation for reasons you see. So here's the cheap shot characterization of Basel II. First, if you're a really big bank, use your internal model to set your capital requirements. Okay? 2, if you're another kind of bank, use an external ratings agency to set your capital requirements. And 3, whoever you are, reduce the risk weighting of residential mortgages because they're so safe. We've really risk weighted them too high. Okay, now I say it's a cheap shot because this is not all that there is to Basel II, but it's not unfair to say that these were 3 very prominent elements, the first 2 in particular, of Basel II. The last year and a half have not been kind to any of these 3 assumptions. Okay? The use of internal models, the use of external ratings agencies to figure out how risky an exposure is, and the proposition that we were risk weighting mortgages way too heavily because they're actually quite safe. So that's the, as I said, the somewhat cheap shot approach. I'm going to skip this, okay, because we're getting a little in time. The less cheap shot, but necessarily complicated discussion of, oops. All right, so this is how, contrary to that approach I gave you to Basel I, this is how the so-called advanced internal ratings-based approach for Basel II proceeds. And I'm not going to run through this, but because it does get very complicated and it takes time. Did put it up there just so you get a sense of the complexity. Here's the basic idea. The bank takes its internal credit risk model. It uses that model to figure out how risky a particular exposure is, whether that's a loan, a line of credit, a securitization enhancement. All right. Instead of using categories created by the regulators, the risk assessment is done, again, by the bank's own internal model, largely, though not exclusively, quantitative. There can be some qualitative element of judgment in assessing the risk. The idea is that the bank has been developing these very sophisticated approaches to risk assessment, to credit risk assessment, that the data the bank has can be tailored to its own experience with a particular borrower, and thus there is merit in bringing together the kind of sophisticated risk management that the bank should do for business purposes with the regulatory system. That's the basic idea. It took 5.5 years to move from that basic idea to the 300 pages of the final Basel II Accord, something that former Comptroller Jerry Hawk famously characterized as presenting mind-numbing complexity to anyone who tried to read it. It's a very different undertaking. Basel I was 30 pages long. Basel II was 10 times as long, and they cheated a bit because they had a whole bunch of other documents that they didn't include in the revised accord itself that you had to hit another link on their website to get to. So that's the formula, okay, for corporate sovereign and bank exposures. We could spend the next 2 weeks in this room, and most of you would not be able to do the capital calculation for the requirements for banks under Basel II. Now that's not a value judgment either on you or on Basel I and Basel II, but it does underscore the complexity of all of this. This requires, even to understand the models, requires a quite extensive understanding of financial modeling. Okay? Securitization exposures, same kind of complexity. This stuff is all in the book if you really want to look at it. All right. So what do I think about this AIRB approach to bank regulation? Well, one of its big advantages is supposed to be it's risk sensitive, unlike Basel I. It's supposed to be risk sensitive. That is, if you have a Kmart loan, it's going to be, would have been, weighted considerably more than a Walmart loan. Right? That's, in the simplest form, that's what it's supposed to be achieving. However, here is where my cheap shot characterization of Basel II comes in. The reliability of credit risk modeling is something that was at issue from the beginning. And the history here is interesting because this builds on the so-called value at risk monitoring that is used by securities firms and other traders, T-R-A-D-E-R-S, traders, in markets. I just want to be clear. To try to give them a sense of what kind of exposure they have. The value at risk modeling for market risks is substantially a better developed art than credit risk modeling. Notwithstanding that, but that's what credit risk modeling is based on. It has to be adjusted for bank lending rather than for trading on a daily basis. As you all know now, the fears of a non-trivial number of academic commentators and former regulators that value at risk modeling was going to come to grief in unusual times has been graphically borne out. And so the whole enterprise of the credit risk modeling effort has been called into question because of its antecedent, the so-called well-established value at risk model for market trading being called into question. But there are even more problems with credit risk modeling. You don't have the kind of data that you do when you're doing market risk assessment because you don't have daily trades to give you a lot of sense of how values change. It's very difficult to stress test credit risk modeling because we don't have a lot of adverse events, which is to say the foreclosures, for example, or default. You have some, but you don't, again, have them on a daily basis. A third thing which actually applies to the value at risk modeling too is the problem of so-called extreme tail events, which is to say that when you get out on the distribution, at the end of the distribution curve, that is when you're talking about something that doesn't happen very often, the losses are enormous. They're just enormous. The problem comes when the financial modelers say to you, I'm giving you a 99.9% assurance that this exposure will not default in the next year. There is a kind of precision in that assertion that is supposed to be reassuring. And indeed, what that tells us is that the extreme event, it's going to be a 0.1% or less chance that the losses will be greater than what the model predicts. But here are a couple of disconcerting facts. This is just now trading models, not credit risk stuff. If you look at the standard distribution of Standard & Poor's indices over the 1929 to 1970, well, in general, what you find is that a change of 5 sigmas out on the distribution curve should occur once every 10,000 years. Okay? Group of academics went back from 1929 to, I think, 2003 maybe. It was about 75 years. And found that there had been about 30 such events in 75 years. So what you've got here is a situation in which, it's even worse than I'm about to say, but in which the 1,000-year flood comes once a decade. And that is a big problem if you're relying on these models to tell you the kind of exposure that you have. Okay? Now, this is one of the reasons why the Basel Committee decided to use its own formulas building on the risk assessment of the models themselves. But it emphasizes for us how relatively undeveloped even the most sophisticated credit risk models are. And in light of the subprime crisis and its aftermath, still continuing, we have even begun to question the utility of the supposedly well-established value at risk models, again, not as a business management device, but as a predictor of the amount of capital that a bank should have. The impact on capital levels is another problem. This gets to the political economy of negotiating this thing. But basically, the short answer gets back to the Northern Rock point. It turns out the capital was going to go down substantially for a lot of banks under the models that had been produced by the Basel Committee, the formulas produced by the Basel Committee and run through the banks. When they did these quantitative impact studies, the regulators were astonished, our regulators in the US, astonished to see average capital declining by 20, 25, 30%. To see that this was a bit on the disconcerting side, to see that very similar exposures were getting risk assessments that were vastly different from one bank's model to another bank's model. I mean, some difference you would expect, right? Because there was a particular set of experiences, and maybe the exposures were slightly different, but not on the order of 40 or 50%. And yet that was not uncommon. This is my judgment, but my characterization. We entered Basel II. We're putting it in place without any reliable sense of what its effect on capital levels will be, because every time the regulators in the United States and the rest of the world did a trial run, they were surprised by the results. And at the end of the day, they threw their hands up and said, the only way we're really going to figure this out is to put it in place. And then we'll see what happens. Now, part of the reason they said that was they thought then the banks would take it seriously. And they would maybe. But if you're shifting your fundamental approach to bank regulation based upon the assumption that you'll figure it all out when it's actually in place, that seems as though it may be a bit more than a leap into a new approach, and maybe there's kind of a cliff there out beyond where you're leaping. Implementation and enforcement problems, I'm going to sum it up just this way. When you say to a bank, what you do for your internal risk management and credit risk assessment purposes now has direct regulatory consequences for the level of capital you're required to have, you introduce temptations. You introduce serious temptations. Even when a bank is trying to do the best job it can, the complexities of these models are such that mistakes, missed assumptions, moved decimal points can have enormous consequences. And when I say the assumption, think back to the most famous of all, long-term capital management. That was a trading model, not a credit risk model. But there was an assumption that two separate kinds of instruments would always converge in value because that's what they had done historically. The moment they didn't, or I should say, the 6 weeks that they didn't, the model was worthless. Because at that point, nothing was performing as the model had predicted. All right, we're going to skip this stuff to get going. Oh, procyclicality. This is a big problem. When you have a model that a capital model that says if a loan is riskier, you got to put more capital aside, and you are more or less continuously reevaluating the risk associated with that particular exposure once a quarter, say, then when times are good, everybody's loans look terrific. Hey, we're growing at 3.5% of the year. There are very few corporate bankruptcies. Consumer spending is on the rise. So the risk associated with every form of exposure, almost, is reduced. That means that you have a smaller base of risk-weighted assets, so your denominator is smaller, so the same amount of capital allows more lending. Now flip it. Times are bad. Lots of personal bankruptcies. Consumer spending is down. Everybody's riskiness is up. So now your adjustments on a regular basis mean that that denominator of risk-weighted assets is growing. And banks are saying to themselves, good heavens, we don't have enough capital to cover. We barely have enough capital to cover the exposures we've got out there right now. We're sure not going to do more lending. As your risk sensitivity increases, the procyclicality of your capital regime increases as well. This is I will say this is a problem that the Basel Committee was very much aware of and has been trying to do something about during this 5 years of negotiation. But even the optimists have acknowledged that they really don't know. The Bank of England did a terrific study on everything we know about procyclicality for credit ratio requirements, and concluded they thought it was going to be okay, but they really couldn't be sure, and we had better keep a close eye on it going forward. Okay. So that's, to sum up, this is the end of this 30-year period of change in how we supervise one very important form of financial institution, which is to say commercial banks, what we call commercial banks in the U.S. To a considerable extent, by the way, in Europe, at least in those countries in Europe that have universal banking, Basel II applies to the integrated universal bank, even though for some pieces of that bank, credit risk is not a big part of what they do. But there can be greater application of even Basel II, though we in the U.S. just apply it to commercial banking. this shift to reliance on capital ratios and reliance on supervision are both understandable given what has come before. But trying to be as fair as I could in the book, I think I stated as there are serious questions as to whether this is a viable model for producing a reliable capital buffer and thereby fulfilling the purpose of capital regulation. Similarly, on the supervisory side, if you're going to rely on these risk models, you have to have people in the regulatory agencies who are as adept as the people in the banks in validating and assessing the operation of the model. Right? Those are hard people to recruit when you're in the U.S. government or any other government, and they're hard people to retain when you're in those arenas, because those are the people who are going to be paid handsomely to go work for, who do you think? The very banks that have to do this modeling. Okay? Everybody in this room can give me an example of a similar phenomenon in some other agency of the U.S. government, where people with a particular kind of expertise as a regulatory matter become enormously attracted to the regulated. And there's nothing, I'm not suggesting anything nefarious about it. It's just a simple fact of life. People with that kind of expertise are valuable. Right? Given the salary, well, maybe the salaries will change on Wall Street now and it won't be that. But given the long-term salary structure, that is a non-trivial problem. It's the sort of thing that you never see written about in an economic article assessing how credit risk modeling works. But if we're thinking about policy, it couldn't be more important. Okay, couple of words now on the international dimension to this. And I'm going to leave most of this because I suspect a lot of your questions are going to be about this. But what I've put up here on the screen is not a summary of what was in the book, chapter 6, but instead suggesting these are the things we need to think about when we have an international arrangement, a sort of international regulatory convergence arrangement like this. What are we trying to achieve and why in this international arrangement? I mean, it really is a surprising fact that you will search in vain in the long history of, or at least the voluminous history of Basel II, for much reference to systemic risk. Okay? The focus is on the bottom-up risk assessment of each individual institution. And so what we've got is an enormous amount of detailed harmonization, taking the better part of 5.5 years, some of the best people, senior, mid-level, in our central banks and our bank regulatory agencies, focusing on this exercise to try to get 300 pages of harmonized capital requirements, while the definition of capital, liquidity requirements, and indeed the larger issues of how risks in one institution can elide into risks for a whole financial system were underappreciated, or if not underappreciated, underinvestigated and under-responded to. The concept of opportunity costs applies in international organizations as readily as it does anywhere else. It also raises the question of what are you trying to do with the institution, the Basel Committee in this case? Do you want a common set of baseline requirements that everybody has to keep the playing field at least workably level? There's an illusion that you can somehow make it perfectly level, but workably level, and at the same time to concentrate on the lacunae in the system, whether it is the supervision of an internationally active bank, or it is an understanding of how a particular activity can have a contagion effect. If it goes bad, will have a contagion effect. There are lots of things that have gone wrong in the last year and a half, the vast majority of which were not going to be countered by Basel II had it been in place, and Basel II could have made things a lot worse. Right? Negotiation versus implementation. What do I mean by this? Well, Are you in a negotiating mode most of the time, or are you trying to figure out how actually to implement your requirements in your country, and thus how to work together to achieve the common regulatory end, in this case, of producing a safe and sound international financial system? Your instinct may be to say, oh, you do both. Well, of course, you try to do both. But as I hope that you will agree with me if you read Chapter 4, the negotiating dynamic takes on a life of its own. It becomes an us versus them, my banks versus your banks. Everybody, governments, members of Congress, banks, everybody becomes, it's like a trade negotiation. The definition of winners and losers becomes sort of well engrafted in everybody's mind. And the common regulatory purpose is at risk of being somewhat pushed aside. And finally, mutual monitoring. What do I mean by that? Well, the irony here is for all that's been done with Basel II, for all that's been done with it, there's going to be very little systematic reporting of what actually is happening within banks, within the Basel Committee itself. Yes, they have an Accord implementation group, and they have a bunch of other groups, and they're going to be working. I know they are working hard. They do work hard to try to work through all of the anomalies and all of the issues that remain, and they are legion, believe me. But what you don't have is any process that essentially allows the Basel Committee as a whole to be a friendly monitor and check upon the implementation of banking or other financial regulations, in any particular country. What good is your 300 pages of detailed rules that you want to be implemented everywhere if you have no capacity to assess whether they're being well implemented? And with something as complex as Basel, believe me, it's going to be hard to figure that out. You're not just going to be able to sit and look at the balance sheet and figure out whether they are or not abiding by the requirements. It's a very opaque process, validating the model, what kind of risk assessments are made, and the like. So I conclude that whatever you think of the advanced IRB approach, whether you want to adopt it, I wouldn't myself. I don't think if I were starting over. I mean, we've got it now, so we've got to make the best we can of it. But whether you're going to adopt it or not, is it a useful exercise within the most important bank regulatory international organization? I think there the answer is much easier, and the answer is no. That is not the best use of the international organization. It creates, all these 300 pages of rules that may or may not be appropriate for particular banking systems and bank supervisors. They're really misguided if applied to less well-developed bank regulatory systems, such as in many countries around the world, which may emulate Basel II. So those are the kinds of questions, it seems to me, need to be asked, and that's where I say the model, the regulatory paradigm, comes together with the international institution to say, what are you trying to achieve and why? So let me close here by, I'm going to forget the alternatives here. I'm just going to go to my recommendations. Okay. Because that incorporates them. So I'm doing this book for Fred's Institute. Okay? Fred wants recommendations. He didn't even have to tell me. I knew that, Fred. Remember, you never had to tell me that. Last chapter's got to have recommendations. It's a good discipline. It's a good discipline because it doesn't let you kind of opine for about 250 pages and then say, thanks very much, on to the next book. All right? It's a policy book. It's got to kind of focus on policy. So before I start to put these things up, I want to make clear, this is not optimal bank regulation that I'm putting up here. The purpose here, and I took seriously what I understand to be the aim of most, not all, but most Peterson Institute books, which is to say, here's where we are now. Here are the problems with where we are. Let's try to move in this direction, and here are some ways to do it, but taking account of reality, certainly on-the-ground practical economic reality, but at least to some degree, political and institutional realities as well. So what have I said? Well, first, they completely didn't address what qualifies as capital. That is, what's in the numerator. Hey, if the numerator is worthless because you got stuff up there that doesn't really provide a buffer, it doesn't matter how much work you do in the denominator, you're not going to get safety and soundness. All right, so that's one. Two, this one's more controversial. Adopt international leverage ratios. Simple rules. Remember I said at the beginning the leverage ratio, simple to do. You can literally do it in 10 seconds if you've got a balance sheet. You look at capital, you look at the total assets. You don't have to do any risk. You just numerator, denominator, hit the button on the calculator, and there you have it. All right? It's a blunt instrument. It is also virtually impossible to evade. Now, you can evade it if you don't write down the values of your assets. We've seen some of that too. But it is much, much simpler and much easier to monitor. And if you talk to regulators, at least in the US, they will tell you that it is a very useful regulatory or supervisory tool to help identify when a bank needs to be looked at much more closely. I say leverage ratios rather than ratio because in addition to capital over assets, we need to find a way of capturing all the off-balance sheet exposures. And if you're just looking at assets on the balance sheet, that doesn't do it for you. I've got a couple of suggestions in here, neither of which is ready to roll, but both of which, one is gross capital over gross income, and the other would be capital over some fixed percentage of off-balance sheet exposures that are unadjusted. Both of those are crude again, but if you do a little bit of back running of bank balance sheets over the last 10, 15 years, you can probably get a pretty good sense of what is sensible and what might be a good complement for the simple leverage ratio. Add a subordinated debt requirement. I don't have Bob Lighton or Hal Scott or Dick Herring or any of the other members of the Shadow Financial Regulatory Committee here to stand up and applaud. And I wish I did, because I'm happy to agree with that. I agree with them to the extent that this is a useful adjunct, I think. And in the interest of time, I'm not going to go into that now. Okay, this is the big one. All right, I'm going to put it all out here. Move away from the 300 pages of harmonized rules as the expectations for everyone internationally. Say that everyone has to have some form of risk-weight adjusted capital. Have a discussion as to what the acceptable such forms are. But don't make everybody have the same detailed rules. A, because we don't really have a sense of what is best, and that's why would we want to impose it on everybody. B, things really do differ from country to country and even from institutions to institutions. And C, as I suggested, the effort to do this just has too many costs at the international level. But then have a requirement for rigorous credit modeling within every bank and try to ramp up the expectations for supervisory actions such as prompt corrective action in the US. Okay? And then finally, strengthen the monitoring functions of the Basel Committee. This gets back to that mutual monitoring point. Okay. There's a way in which trying to do things internationally, like negotiate 300 pages of harmonized rules, is probably misguided. Okay? But what would be profitable, what hasn't been done, what might be done? Well, first off, obviously, is making sure that when you have supervision of very sophisticated things like credit risk modeling, that there's both a learning process for everyone involved in this, the small numbers of regulators from each country who are going to do this, and there's the capacity for everybody, meaning other countries that expect each country to abide by this, people in our own country who have no way of figuring out whether the supervisors are doing a good job of validating these models or not. We don't have this kind of expertise or ability to get inside the banks. The rest of the Basel Committee can be a surrogate for the public interest in good, solid, rigorous supervision of these credit risk models, and at the same time provide a forum for evolving a more sophisticated, informed approach to the supervisory process of model validation and oversight. And so in what is probably the biggest conceptual break, what I've suggested here is you actually get an international level group that would itself have the charge of inspecting and validating models within the big banks in each of the G10 member countries. Not all of them. They're not going to take it over. But as a supplement to, as an adjunct to, as a learning device for, and as a check upon supervisors in every country. And then finally, this is an easy one, but it hasn't been done. We just need a lot more transparency. What are the capital ratios of all the banks? What are their positions? How are risks allocated? There is very little of this kind of reporting today. And if you're going to have a system that relies so much upon this kind of modeling and using the banks, then you need to get the maximum amount of information out there so that people like Dick Herring, Dick has been on modeling and on Basel II for a long time. He's at the Wharton School. So he is in a better position to provide an informed critique for all of us as to how the modeling is going. All right, so that's Basel II. Because I've sort of hit a little even beyond the time that Fred suggested, I'm going to stop there without having explicitly said, so what does this mean for everybody else? Because, as I say, I suspect that may be a bunch of the questions. Okay, so
Dan, thank you.